Just very quickly, thank you very much for giving up your time this evening. I'd also like to thank Nick at the Canadian Chamber of Commerce and Alan for inviting us along. What I'd like to do is just try and shed some light about really what took place last year and what we at Castlestone, our views are for probably the next 12 months and why we are out talking about real assets. And by real assets, I'm talking about gold, I'm talking about art, I'm talking about oil, I'm talking about commodities, so that might be copper, it might be agriculture. And last year, when we saw this tremendous market crash, what we saw at the beginning of this year was governments around the world came together to initiate these huge packages of quantitative easing to try and salvage the global financial markets. And I think they did. I think what they set out to do worked. I wouldn't say they're going to be a panacea to future growth, but what it did do, it stopped the turbulence and markets falling. And since then, with the amount of money that's been pumped into global economies by central banks, Castlestone, we've been out on the road talking about why you should own real assets. Look, last year, my CEO and owner of Castlestone, Angus Murray, stood up on Bloomberg TV and made a call. And when he did it at the time, I thought he'd gone mad. I was a bit worried. But what he did say, he said that he thought he'd see oil at $75 a barrel by the end of this year. Right now, just before I came down this evening, from my room, oil's trading about $77 a barrel. Then in February, he made another call. He talked about gold being $1,200 in 3 years. Right now, gold is sitting at $1,216 an ounce. This is quite extraordinary. And if you look at some of the commentary that's coming out from other banks like Credit Suisse, Deutsche Bank, they're talking about gold reaching $1,300, $1,400 an ounce, probably by May, June next year. And look, let me just run you through why some of these things have happened. If you look at the price of oil, if you remember last year, the price of a barrel of oil peaked at $147 a barrel. Then the global economy went into meltdown and it fell all the way down to $32 a barrel. But what we're seeing is that oil has climbed off its lows of $32 a barrel to $72 a barrel. And the reason for that is nothing more than market sentiment. If you look at oil inventories, there's still a lot of oil held in storage facilities. If you read the stories JP Morgan are doing, they're hiring oil tankers and they're parking them off the north coast of Scotland, waiting for oil to hit $85 a barrel before they start bringing them into the UK. I think it's phenomenal that oil is at the price it is today because it's there with really no fundamental economic growth story behind it. But my point being is that if you read the commentary, you look at some of the comments that Trichet's come out today, technically now the Eurozone is out of recession. The American economy, I believe, is beginning to turn the corner. Once we have proper economic, robust growth, we're going to be back to $100 a barrel for oil. And I even go as far as to say that we're probably going to see that as early as April and May next year. Likewise, this is conspiracy. Likewise, if you look at the price of gold, what you saw last year was as financial markets literally fell off a cliff, people saw the oldest store of value there is in the world. They saw a safe haven asset. And that asset that everybody flocked into when they were selling off their financial assets, whether that was bonds, people getting out of property, people selling all their shares, they all flocked into gold. And gold was probably the only asset class last year that finished up into positive territory. And look, I was talking earlier about where the world is at the moment on the back of these huge quantitative easing programs. The real story, and I'm sure you're all aware of it, is what's happening in emerging markets. If you look at where China's positioned today, if you look at where India's positioned today, you can clearly see that we're seeing huge economic growth return. We're seeing a revision of upweighted GDP numbers. And my theory at the moment is that when I look at global equity markets around the world, I worry that we're creating an asset bubble. Because oil's trading at $77 a barrel, there's a huge amount of hot money around the world at the moment looking for a home. And the Shanghai Composite is up around 80% this year. I think that's nuts, and that's lots of old ladies in Shanghai taking out their savings and going back into the market. The Brazilian government and the Indonesian government have looked at trying to introduce capital controls to stem the flood of hot money. If you look at the FTSE, you look at the CAC, they're all up, and it's a phenomenal gain. And I'm not convinced that where we are at the moment is underpinned by a robust economic recovery. So my view is that I believe equity markets will come off somewhere between 10 and 15%, probably January, February of next year. And just talking about gold, if you had your money invested in shares in 2001, you put $100 in and you took it out today, you'd probably be left with about 96. If you bought gold, you would have actually trebled your money. And the reason for this is as follows. Last year, people went into gold as a safe haven, but what we're seeing at the moment is that there's still uncertainty in the market. We're seeing a falling dollar. So what people are doing is they are now viewing gold as the currency of last resort. And I have to say, when I look at how the dollar's performing against a basket of currencies, whether it's the euro, whether it's sterling, or whether it's the Swiss franc, I believe that the Fed are being complicit in letting the value of the dollar fall. And why? It's common sense, because the Americans can then export themselves out of trouble. The other reason for gold being where it is today is that people are looking at momentum trades. I think gold has become an asset class in its own right, and again, this goes back to what I was talking about earlier, that I think there is a view that we are creating an asset bubble at the moment because we are holding interest rates down so low. And if you look at some of the commentary that's come out, there is a concern that, as I said earlier, equity markets are going to come off. If that happens, that's going to add a further springboard to gold. And people often say to me, why don't I just own gold mining shares? Why don't I own exposure to BHP Billiton, Anglo-Plats? Why don't I own these type of equity products? And my argument is that you need to own the real asset. You need to own something that can't go to zero. If you held Lehman shares last year, they ended up being worthless. But a barrel of oil is always going to have an intrinsic value. A bar of gold is always going to have an intrinsic value, as is a bushel of wheat. Likewise, the other area that we are very bullish about is the other precious metals, which are platinum and silver. And if you look at where platinum is at the moment, although it's a precious metal and it tends to track gold by 4 to 6 months, what I like about platinum is that it has industrial metal qualities. So 64% of all the platinum mined in the world is mined down in South Africa, but that is all used in catalytic converters in China. And last week, China became the biggest buyer of automobiles in the world. Chinese car sales are now running at 74%. And there's other good news coming out of the auto sector. I don't know if you remember, but General Motors were going to do a deal where they were going to sell their business in Europe and the UK to Magna. What they've done is they've now pulled back for that because they've seen growth in the auto sales unit. So again, that to me is more reason why not only should you be looking at platinum as a holding because it's precious metals quality, but it also has industrial metals usage. And once we see the American economy begin to turn the corner, we're already seeing the Chinese economy go motor ahead, then I think platinum would be a good opportunity. And just to look at what happened to platinum last year, I think now is a good entry point because you can see that platinum ran all the way up and then last year it got sold off. So I still think round here represents a buying opportunity for platinum.
Went up incredibly yesterday.
Yeah. And look, these are the numbers that we've taken from Barcat, and these are Chinese auto sales. I mean, they're going at an unprecedented rate, and a lot of that is being driven by the amount of money that the Chinese government have pumped into their economy, which is $586 billion US, and I think there probably might be a little bit more to come. But that is what's driving automobile consumption. The other piece of good news that's come out of China is that they've now adopted EC emissions legislation. So by 2014, all cars that run in China are going to have to be fitted with a European-type catalytic converter. And silver is the other metal that I am out in the market talking up. The reason being, again, silver tends to track gold between 4 to 6 months. Silver, as you know, is used in battery applications, lighting applications, and medical applications.